So let's move into your Compendium of Solved Illustrations on Ind AS 36, guys. You'll have a significant learning from here. Each and every question will only give you better clarity on the standard. That is my promise. Let's look at the questions. Impairment under Ind AS 36. Let's start solving from the question number 1. A mining entity owns a private railway to support their mining activities. The private railway could be used only could only be sold as scrap value, and it does not generate any cash flows which are largely independent of cash flows from other assets of the mine. We did discuss this point. We said whenever we have such an activities such as roads, railways and bridges which are not independently generating cash flows, but they have to be checked for or tested for impairment or capitalized as per Ind AS 16 along with the mining activities or along with the mining machinery. Therefore, even these railways which are not generating any separate cash flows independently but can only be sold as scrap, they should not be tested for impairment individually. They should be tested for impairment only along with the entire mining machinery or entire mining activities as a whole. Clear? It is not possible to estimate the recoverable amount of private railway because its value in use cannot be determined, and it is probably different from the scrap value. Consequently, the entity estimates the recoverable amount of cash generating unit to the private railway cash generating unit to which the private railway belongs, that is the mine as a whole. Clear? Guys, whenever such question is given, please make sure that you start writing from the paragraph of Ind AS 16 as well. Ind AS 16 says they cannot be controlled, so you cannot capitalize them as a separate asset. Therefore, they should only be capitalized along with the mining machinery. Hence, the impairment also should be tested only for the entire mine as a whole or the entire mining machinery as a whole. You cannot test for impairment individually. Clear? Look at the question number 2. A bus company provides services under a contract with a municipality that requires a minimum service on each of the 5 routes. Even this we have discussed. The assets devoted to each route, but the cash flows from each route can be identified separately. One of the routes operate in significant losses. Can you impair only that route? No. All the routes put together have to be considered as one single CGU because I cannot operate only on one route. I have a contract to supply or which requires a minimum service on each of the 5 routes. So therefore, all 5 routes only on combination can generate cash flows. If I discontinue one route, then the contract itself is void. So I'll have to cancel the entire contract. Therefore, it is not possible for you to derive benefits from only one particular route alone without deriving benefit or without incurring losses on other routes. Therefore, you have to treat all the routes as one single CGU and try to calculate or measure the impairment for all the routes as one single CGU and not for each route separately. Read the answer. Because the entity does not have an option to curtail any of one business route, the lowest level of identifiable cash flows that are largely independent of cash flows from other assets or group of assets are the cash flows generated by all the 5 routes together. Therefore, the cash generating unit of each route, the cash generating unit of each route is the bus company as a whole, or all the 5 routes as a whole can be considered as one single cash generating unit. With this problem, we have solved as a part of our illustration. Look at the next one. The company owns 3 hotels in the same location. The hotels use the same pricing structure and are advertised by the owner as alternatives. So you can either dine here, or you can dine here, or you can dine here. The menu is the same. The food is the same. It is only for your convenience that I've started in 3 hotels in the same location. But all use the entity's centralized reservation system. The guests are regularly transferred between the hotels. The entity also owns a hotel in another location. This hotel uses central reservation system but does not share the advertisements or guests with the other hotels. Now, you tell me How do I identify CGUs in this case? Those three hotels which are in the same location, can they be considered as a single CGU, or should each hotel be considered as a separate CGU? Now, if you look at the indicators in the question are, number one, see, you don't say same pricing, sir, so it is the same CGU. You also always have to look at cash flows generated, whether they are dependent or not. Look at it. They use centralized reservation system. It is the guest of the customer which generates a cash flow. So therefore, the guest is regularly transferred between hotels. Since they are regularly transferred between one hotel to other, that means the cash which is being generated from the customer is dependent from one hotel to the other hotel. So therefore, you can always say that all these three hotels which are in the same locations can be considered as one single CGU. However, what about the fourth hotel? He owns a hotel in another location. It uses the central reservation system but does not share any advertisements or guests with other hotels. Since the guests are not being shared, since the cash outflow of advertisement not being shared, you can treat the fourth hotel in another location as a separate CGU, and these three hotels in the same location which are actually having transfers of guests from one hotel to other should be considered as a single CGU, because their cash flows generated from each hotel among those three hotels are interdependent on each of those hotels. Three hotels in the same location would form part of a single CGU because they are managed as one business. Fourth hotel is in a separate location and would be another cash generating unit because it is likely to be managed independently, and the company of the entity's other hotels and the management is likely to be held accountable for the profitability of the hotel as an independent business. Clear? These are magazine titles. We have seen this. A publisher owns 150 magazine titles. 70 were purchased. 80 were self-created. The price paid for the purchased magazine title is recognized as an intangible asset. The cost of creating a magazine title, maintaining the existing titles are recognized as expense as and when they are incurred. Cash inflows from direct sale and advertising are identifiable to each magazine title. The title may be managed by customer segments. The level of advertising income for the magazine title depends on the range of titles in the customer segment to which the magazine title relates. The management has a policy to abandon the old titles before the end of the economic life and replace them immediately with the new titles from the same customer segment. What is the cash generating unit? All titles put together are considered as one single CGU. We've already discussed this. I'll just read through the answer. It is likely that the recoverable amount of individual title can be assessed, even though the level of advertising income from the title is influenced to a certain extent by other titles. The cash flows from direct sales and advertising of each title are identifiable. In addition, although titles are managed by customer segments, decision to abandon the management title, each title can be abandoned separately on an individual basis at the end of its useful life, gets replaced by another title. That's an indicator that each title can be treated as a separate CGU because they are generating cash flows largely independent of other magazine titles. We've seen this question. Question number 4, we have discussed this as a part of illustration. Read through question number 5. A significant raw material used in plant-wise final production is an intermediary product of company plant X of the same enterprise. X products are sold to Y at a transfer price that passes all the margins to X. 80% of Y's production is sold to customers outside the reporting enterprise. 60% of X production is sold to Y. Remaining 40% are sold to customers outside the reporting enterprise. For each of the following case, what should be the cash generating unit for X and Y? X could sell these products sells its products, it intends to sell to Y in an active market. Internal transfers are at a price higher than the market prices. However, in case 2, if there is no active market for product of X and X only sells to Y. So what are these two cases that he is talking about? The first case that he is talking about in this question number 6, the enterprise owns two plants. Plant X and plant Y. The production of plant X becomes the raw material to plant Y, and plant Y is selling it to outside customer. Similarly, X can also directly sell to customers. You don't have to sell it only through plant Y. A certain amount of production is transferred to plant Y for further production. Certain amount of production from plant X is directly sold to customer. In this case, this particular plant X it is capable of generating cash flows which are largely independent of cash flows derived from plant Y. Therefore, since you said it is capable of generating cash flows largely dependent of plant Y, X should be tested for impairment individually, not in combination with Y. What about this plant Y now? Plant Y anyways is a separate CGU. There is no discussion regarding this. And I am looking at plant Y. Predominantly it is generating cash flows from sale to customer. Y generates cash flows from sale to customer. Therefore, tested for impairment individually. Under this case, he is saying X might sell it to the customer at market price, but X is selling to Y at a price greater than the market price. I'll put that sentence. Where the transfer price from X to Y, from plant X to plant Y, if the transfer price is greater than the market price at which you are selling it to the outside customers, in such case, the estimated cash flows of plant X and Y should be measured on the basis of market price. It should be on the basis of market price and not the transfer price. Transfer price is irrelevant when we're talking about measurement of estimated cash flows. Clear? So transfer price is completely irrelevant, guys. You don't have to look at the transfer price at all. Only look at market price, and based on that market price, you estimate the cash flows derived from plant X and Y. This transfer price is irrelevant in measuring for impairment or value in use for the purpose of testing for impairment. But how will your answer change? How will your answer change if I put up this statement like this? X, Y, customer. Movement is only like this. X transfers to plant Y. Plant Y sells it to customer. But X does not sell to customer directly. X sale to customer is not possible. There is no active market for the intermediary good produced by X. If the intermediary good produced by X does not have an active market, then in such case, it may not be possible to measure cash flows derived from plant X independently. Since I am not able to derive the cash flows from X independently, therefore in such situation, X should be tested for impairment along with plant Y and not independently. That is, X and Y should be considered as one single CGU. Considered as a CGU, cash generating unit. Here, X cannot be tested for impairment individually or independently. So therefore, it should only be tested for impairment along with, in a combination with plant Y. So therefore, X and Y together will be considered as a single CGU. You cannot test for impairment of X independently. These are the two parts of the question that is asked. First part, X also sells to customer, X also sells to Y, Y sells to customer. So the product of X has an active market. Therefore, in identifying cash flows derived from product X, I will try to identify such cash flows derived from product X based on the market price of the intermediary product which is generated out of the plant X. However, when the transfer price is greater than the market price, I will only determine the cash flows. Why do you need cash flows? In measurement of value in use, I will take the cash flows. So cash flows of plant X and cash flows of plant Y should be determined based on the market prices and not based on the transfer price. Clear? But if in case whatever intermediary product is generated out of plant X, there is no active customer for it. I don't find anyone being active customers to buy this product. In such cases, you cannot generate cash flows independently from plant X. For you to generate cash flows from plant X, it should always be combined with the further production done in plant Y. Therefore, cash flows are only identified based on both plant X and Y together and not for plant X separately and plant Y separately. In such cases, you cannot individually impair plant X and plant Y. They have to be impaired in combination by considering X and Y as a single CGU. Clear? I think this was also a question which we have discussed earlier. Entity M, question number 6, guys. Entity M produces a single product, owns 3 plants, ABC. Each plant is located in a different continent. A produces a component that is assembled in either B or C. The combined capacity of B and C is not fully utilized. M's products can be sold worldwide either from B or C. For example, B's production can be sold in C's continent if the product can be delivered faster from B than from C. The utilization level of B and C depend on the allocation of sale between the two sites. For each of these following cases, what is the cash generating unit of A, B and C? A produces a component, guys. This particular component can either be sold or it can be assembled in either B or C. Now, which one will I use? I have no particular clarity. He's saying none of their capacities are fully utilized. You cannot say B is fully utilized, so I'm transferring it to C. No, they can either be sold worldwide through B or C. So there is no particular limitation. In B's location, I can sell it from C's machinery. In C's location, I can sell it from B's machinery, so that to make sure that there's a faster delivery. B and C cash flows cannot be considered independently, because B and C put together the entity is using as one single set of machine to ultimately deliver the product to the customer. I might use B or I might use C. I am really not demarcated. Therefore, B and C put together are generating cash flows to the enterprise. Therefore, they should be considered as a single CGU. You cannot consider them as separate CGUs because the cash flows generated from B and C are largely independent of each other. Largely dependent of each other. What about A then? A is producing components. If these components produced by A have an active market outside, then you can say that A has a capability of generating cash flows independent of other assets in the enterprise. Therefore, in such cases, A shall be treated as a separate CGU and shall be impaired individually. But if you say A's intermediary product have to be further processed in B and C only, they cannot be sold in the active market. There is no active market for the product out of plant A. In such cases, plant A is necessary to be combined with B and C to be considered as a single CGU for the purpose of testing for impairment. So, let me write down. I'll write it in brief, guys. I don't want to discuss little too into detail. What am I saying? The case is something like this. There's a plant A. It produces certain components. They are either assembled in plant B or they are assembled in plant C. Either from plant A, B or C, I can actually sell it to ultimate customer. They can receive goods either from plant B or they can receive from plant C. Clear? So whenever I am talking about this concept, okay, my question is, this is a plant which is actually generating certain components. These components are assembled in these plants. Now, he never said plant A is selling it to outside customers. However, let's first conclude our discussion on B and C together. Plant B and C. Generate cash flows largely dependent on each other. Cash flows generated are largely dependent on each other. Since the enterprise operates them as a single business, either he'll sell it from B or he'll sell it from C. There is no demarcation at all. B's continent is this, C's continent is this, nothing. What about entity A then? Or plant A then? Plant A can be considered for impairment individually if it is capable of generating cash flows independent of plant B and C. When it is capable of generating cash flows independently of plant B and C, that is, active market exists for components of plant A or components produced by plant A. If there is an active market for components produced by plant A, you can consider them as a separate CGU independent from B and C. Else, plant A should be tested for impairment together with plant B and C. There is no active market for components produced by plant A separately. Then in such cases, I will test it for impairment together with plant B and C. A, B, C put together should be considered as one single CGU. the answer? Yeah, there's an active market for ACE product. There's no active market for ACE products. He has given both the cases. Even if it was not given, I would have answered it. It is likely that A is a separate cash generating unit because it has separate products. Although there is an active market for the products assembled by B and C, cash flows of B and C are dependent on the allocation of production of both the sides. It is unlikely that future cash inflows from B and C can be determined individually. Therefore, it is likely that B and C together is the smallest identifiable group of assets which generate cash flows from continuing use of the asset, which are largely independent. In determining the value of volume use of A and B plus C, M should adjust its financial budgets and forecasts to reflect the best estimated market prices of A's products. Market prices are there because there is an active market. Under case 2, when there is no active market, it is likely that the recoverable amount of each plant cannot be assessed individually. Because there is no active market for A's product, A's cash flows depend upon sales from B and C. Although there is an active market for the products assembled by B and C, cash flows of B and C are dependent upon allocation of production across these two sites. It is unlikely that the future cash flows of B and C can be determined individually. As a consequence, it is likely that A, B, C, all three plants together should be considered as one single CGU for the purpose of testing or for impairment. Clear? Question number 7. Read through. Apex Limited is engaged in steel utensils. It owns a building for its headquarters. Building was fully occupied for its internal use. However, recently the company has undertaken a massive downsizing exercise, as a result of which 1/3 of the building became vacant. The vacant portion is now let out on 6 years lease. Determine the CG of the building. We did discuss this in detail. I said the lease rentals derived from 1/3 of the building, which is let out on a lease for 6 years, those lease rentals are largely independent. They are largely independent of other cash flows or other cash flows generated from the other asset. Therefore, to the extent of that 1/3 portion, if it can be identified separately, then it should be considered as a separate CGU for the purpose of measuring for impairment. However, to the extent of the remaining 2/3 building, which is owner occupied, my corporate building, then I will have to treat it as a single corporate asset. Such corporate asset, to the extent of the 2/3 part of the building, should be allocated to other CGUs on a non-arbitrary basis. Answer given down below is not comprehensive. Please make sure that you write the answer which is appropriate. We did discuss about this, I think under workbook or under illustrations. We had this discussion on question number 7. Clear? Moving on to question number 8. Saturn India Limited is reviewing one of its business segments for impairment. The carrying value of the net asset is 40 million. Management has produced two computations of value in use. First value, 36 million, excludes the benefit derived from future reorganization. Second value, 44 million, includes the benefit derived from future reorganization. There is no active market for the sale of the business segments. Whether the business segment can be impaired. No active market for the sale of business segments. No net selling price can be measured reliably. No problem if net selling price cannot be measured reliably. Recoverable amount is equal to value in use. But here he is giving you two value in uses. One is 36 million without considering the benefits derived from future reorganization. 44 million if you consider the benefit derived from future reorganization. Which one should I consider? If you remember your determination of value in use, when we had a discussion, we did talk about inclusions in cash flows and exclusions in cash flows. Under exclusions in cash flows, I excluded income tax, I excluded financial cash flows, I excluded even administration and selling cash flows, I excluded even your future planned reorganization cost or restructuring cost, and together with benefits derived from such restructuring costs. Because the fundamental reason is I am determining value in use today. On today's date, the way I find the asset today, on that basis, what is the value in use? Tomorrow, I will improve the asset. Tomorrow, I will derive better benefit. They should not be considered in determination of value in use on a particular date. So, future planned restructuring cost and benefits derived from that future restructuring cost should not be included in determination of cash flows for the purpose of measuring your impairment. That is sufficient. Therefore, the answer to be considered here as value in use or the recoverable amount is 36 million. Since carrying value is 40 million, value in use is 36 million. Therefore, there is an impairment loss to be recognized to the extent of 4 million.